So the economic recovery that we're now in is 10 years old, making it the longest period of expansion since they started keeping records a really long time ago. Two questions that I've been asked pretty much nonstop all summer. Hey, Bob, I keep reading that it looks like we may be going into a recession. And then the other question is, what's up with this inverted yield curve? It's kind of scaring me. I've read about it. So those are the two questions that I get asked. So I'm going to spend time trying to drill into both of those issues. Worries about a possible recession have increased in the last few months. Trade wars, weaker growth for Europe and Asia, and now a manufacturing slump in the U.S., the inverted yield curve, as I mentioned, and the fading effects of the tax cuts that we saw on December 17 have really been weighing on the markets. For the first time in 10 years, the Fed cut rates at the end of July, and then again yesterday. Tells you that they're worried about economic growth and they want to stimulate the economy. So overall, the economy is weakening the most since the financial crisis. It was only a year and a half ago that the International Monetary Fund talked about synchronized global growth, the concept of many of the developing nations all growing their economies simultaneously. So that stopped. The slowdown in Asia, principally in China, spreading to Europe, and now the United States has created the most weakness since the financial crisis. This next point's easy to understand and explain. Trade wars have reduced trade, slower manufacturing activity, and less investment spending. So the principal point here is when businesses try to spend money, they need clarity. They need to be able to see the future. You can deal with tariffs as long as the story doesn't change every other day. So a lot of businesses are sitting on cash. They're afraid to deploy cash because they can't see clarity. I've looked at enough business plans over the 40-something years that I've been doing this to tell you that if there are too many variables in your plan, it's not a plan, it's called a guess. So companies are sitting on cash because they're unsure of what tomorrow's going to look like. There is increasing evidence that the trade conflict has already done significant damage to the global economy. So as to say, even if they kiss and make nice this afternoon, we still have a host of problems to deal with. Global purchasing managers, here's one of my favorite indicators. People at companies that have to buy supplies, raw materials for production, they got a pretty good finger on the pulse of where we're going. Purchasing managers index around the world is weak. Most are contracting. The manufacturing is now contracting in Asia, Europe, and even now in the United States. Chances of recession have gone up rapidly since just the springtime. The trade war has been particularly painful here in the United States for manufacturing and for agriculture. Agriculture, that's easy to explain. The Chinese stopped buying for a while. All imports of agricultural products from the United States just track the price of soybeans to look at that. Most, we only grow 3 crops for the most part in the United States: wheat, corn, and soybeans. I never knew until last year that most of the soybeans that we sell to the Chinese were used to feed their pigs. And we just stopped selling them because they wouldn't buy it. So agriculture, you look at what's going on, John Deere, Caterpillar, a host of other industries that support the farmers, not doing so well. Factory output in China fell to the lowest in 17 years. That data point just came out a little bit ago. Here's another issue about trade. Even if we resolve trade quickly, the trade conflicts, it doesn't solve many of the problems that are plaguing China. Right? So there are all sorts of economic problems in China that have nothing to do with trade. So it's wrong to suggest that if they resolve the trade wars, that everything will be fine in China. So trade conflicts have nothing to do with the real estate problems in China. They have nothing to do with all of the loans that are off the books and records. Boy, that sounds kind of familiar to what we went through 10 years ago. They're struggling to really establish a consumer class in China. So just trade is just one of their problems. Business spending drops significantly. Here's another key point. If business spending drops, it could result in layoffs, weaker job market, weaker consumer spending. I remarked to one of my colleagues the other day that it had been years since I read anything in the newspapers about layoffs. And then all of a sudden, just recently, Nestle here in Wisconsin laid off a whole lot of people. Harley Davidson laid off 50. That's just the beginning of what I understood to be a series of layoffs that they're looking at. So I haven't seen, none of us have heard about layoffs, and it looks like we're just on the cusp of that turning. My opinion, President Trump is right in pushing back against abusive Chinese trade practices. The problem is, once trade wars start, they're really hard to stop. And as we've seen, they're not easy to win. I mentioned trade wars are only part of the problem. Look at all the headaches Boris Johnson has in Great Britain. Brexit, you've probably noticed, isn't going well. I just can't imagine them severing ties with the European Union without having anything understood ahead of time. We're seeing significant problems in Hong Kong. I've often enjoyed the time that I've spent in Hong Kong. Can't believe what I'm watching on television there. Hong Kong markets, of course, are negative for the year. So are the South Korean markets, big player in Asia. They're negative for the year because their conflicts with Japan, let alone the problems with India and Pakistan concerning the folks in Kashmir. So, yeah, you're right. It is all about interest rates and earnings. Those are the two things that they figured out years ago that cause stocks to go up or down. But geopolitical risk can upset markets short term, so it's a pretty good idea to pay attention to the pressures they bring to the markets. Now, we've never had a recession in the United States that started overseas. It's never happened. That, of course, doesn't mean it can't, doesn't mean it won't. I'm just telling you it's never happened. And there's a really simple reason for that. We're somewhat of a closed society here in America. Only 12% of our GDP is exports, right? We mostly sell to each other in Missouri, Indiana, Ohio, right? Only 12% of our economy is exports. Compare that to Germany. 48% of their economy is exports. And guess what? The Chinese aren't calling them like they used to. Germany is just on the cusp, largest economy in Europe, just on the cusp now of contracting. Most of the pros think that they're going to drag the European Union into recession by the end of the year. Now, the potential good news is part of these problems are solvable. Trade wars are within the power of policymakers and politicians to end. A couple of basic Econ 101 points I want to make here. 70% of the U.S. economy is consumer spending. So you try to back into the issue of are we going to have a significant downturn or not, really helps to look under the hood to get a sense of how could it play out here in the United States. So consumer spending is fickle. It changes quite a bit month to month, somewhat volatile. But right now, consumer spending is fairly strong. As they say, do the math, business spending is 14% of our economy. That's the one you got to worry about. And government spending, 16%. As we've all read, we're going to hit $1 trillion deficit, budget deficit this year. That's a huge number during a period of prosperity. So when you look at business spending, it is going backwards. Companies are spending less. They're sitting on their cash. They can't see clarity because of the trade conflicts. But in my opinion, business spending is declining, but unless the trade wars intensify, won't be enough to put us in recession. So folks, every economic forecast that I've been reading here for over a year has got a caveat or a disclaimer that says basically the same thing. Here's our forecast assuming that the trade wars do not intensify. Here's how we think it's going to play out as long as the trade conflict doesn't worsen. So that's the key to your understanding this point in history right now. The problem with forecasts is the world's change. Every day I wake up just a little bit different. So assuming the trade wars do not intensify, my opinion, we're going to avoid a recession. So U.S. consumers are in good shape. Wealthier than ever, healthy balance sheets, unemployment near a 50-year low. So again, a period of sluggish growth looks more likely than a recession. So as a trained economist, I can tell you a trend line. You guys know trend line just reading the newspapers. We had 3% GDP last year, 2% this year, maybe 1% next year. You get the idea, we're going down, right? But it's really hard to forecast beyond that. So this next story, I've probably told to half the people here in the room, so once more is not going to hurt. Client of mine, well-known retired meteorologist. Nice guy, I've worked for him for a long time. I came across a study that the New York Times published that said weather forecasting past 24 hours is no more accurate than random guessing. So I made the mistake to show that study to my client, and he immediately just barked in my face and said, well, they're about as accurate as your forecast, Bob. And, you know, he was right. It's hard to forecast weather. It's complicated. All the things that you need to do, I got a pretty good chance of telling you folks whether it is going to be a little on the warm side, partly cloudy. You get past a couple of days, you got to figure out all sorts of variables that are really challenging to put together. And my business is the same. And here's why. Recessions aren't caused by a specific data point. They're not caused because some company goes down one morning or an index of leading economic indicators collapses. They're caused because of a crisis of confidence, and those are really challenging to predict. So go back to 2000. Right, Y2K. It was when Sun Microsystems evaporated. Tech stocks were only 11% of the market then. But people panicked when Enron went down, when WorldCom went down, when Sun Micro basically just evaporated, and people panicked. And they stopped spending money, and that put us in a recession. But tech stocks back then weren't enough for the market to really do much more than hiccup. But it was this crisis of confidence that was very difficult to forecast, because how are people going to react to some of the biggest bankruptcies in U.S. history? And they were all back-to-back, WorldCom, Enron, and Sun Micro. So fast forward that to 10 years ago, you know, housing gets talked about a lot. It's only 6% of GDP. It's a measurable number. It's not that big. But people freaked out when their houses started going down in value. So it wasn't just junk mortgages, wasn't just elevated house prices, is that we had all been told, and we mostly believed, that housing in nice neighborhoods in the United States basically never goes down in value long term. So that's why it's difficult to forecast recessions. It's almost impossible, because what you're trying to do is forecast a psychological reaction to a set of events. And that's just really challenging. So if you look at this chart, it gives you an idea of why we'll probably avoid a recession. Look on the far right-hand side, that's household net worth. Hit $108 trillion recently. It's a record. You look at the orange line, some of a technical point, but it's household debt service as a percentage of discretionary income. Well, it's just way down compared to where it was 12, 13, 14 years ago. Good news, bad news on this chart. Good news is wealth hit $108 trillion recently here in the United States. Bad news is almost all of that wealth is owned by half of the Americans. Right, so as we hollow out the middle class here in the United States, as income equality worsens, you've got half of the country, as measured by population, that has few, if any, assets, and will be challenged to hang on the next time the recession comes. A couple more economic points I want to make before I switch over to the markets. So the government here in the United States has two tools that normally use to try to steer the economy: monetary policy and fiscal policy. So monetary policy, as most of you know, is the Fed raising interest rates, lowering rates, buying bonds, selling bonds, setting the discount rate, among other tools that they have in their toolbox. Fiscal policy is government spending. And what I'm reading in more and more forecasts is that there are limits at this point on monetary policy and fiscal policy. Consider that short-term rates just before the financial crisis were at 5.25, right? So they're at 2 now in the upper range. The more that interest rates go down, the less powerful monetary policy becomes. So we're running out of maneuvering room with interest rates that low. As I mentioned a bit ago, the budget deficit hitting $1 trillion, that's a big number, but it does limit the ability of the U.S. government to spend money to keep us out of trouble. Low rates, of course, in the U.S. won't help people in Europe or Asia. And then here, more of a technical point, the two industries in the United States that react quickest to lower rates are both somewhat struggling. So housing, right? Mortgage money was this low 3 years ago. Lowering rates now won't create an avalanche of buyers. But the greater issue is affordability. The average American family now cannot afford the average price house in the country. So we're pricing folks out of the market. Manufacturing is the other. Manufacturing is slowing because of the uncertainties of the trade wars. They're afraid to spend money. It's unlikely that if they lower rates, that will create incentives for manufacturers to deploy money. The only thing that's going to work there is, of course, clarity on the trade issue. So we talk about impediments to growth. I'm going to gradually set you up for one of my big economic points here this morning. We've got a shrinking workforce, what we call the labor force participation rates. Keeps going down. Fewer workers. Productivity growth, so output per hour worked, that's been anemic. I'm going to show you some slides. And lack of pro-growth policies out of Congress. It's unlikely with a divided Congress to find any kind of common ground. Seems like they can't even agree what time of day it is. So we've got some structural impediments that are hard to address. All right, so here's the part I want you to remember. There's only two ways to increase wealth. Got it? Only two. And they're easy to explain. So if I have a company that makes watches, and you all work for my watch company, right? I need two things to be able to pay you more and for me to make more as the owner of the company. Number one, I need more workers. And number two, I need to make y'all more productive. We all collectively have to figure out how to make more watches per hour for you to be able to make more and for me to be able to make more as the owner of the company. Okay, got it? More workers, and you have to make them more productive. So I'm going to spend a little time on this chart. It's one of my favorites of the morning. So let's start off with the basics here. The orange line on the bottom is growth in output per worker. Can you make more watches an hour? Okay. The blue line above it is growth in workers. Look at the big blue bar on the left side. Covers 1969 to 1978. You know why it went up? Women entering the workforce. When I got out of high school in 1970, only a third of the women in the country worked outside the home. My mother worked outside the house the whole time I was growing up. But it was pretty unusual back when I was a kid in the 50s and 60s for women to work outside the house. Within 10 years, it changed from a third to two-thirds. So we had a huge increase in workers available, and it was primarily because of women entering the workforce. As I said, went from a third to two-thirds in a really short period of time. But guess what? Growth in workers peaked out in this country over 40 years ago. We go from 2.4% increase in the workforce down to 1.8%, 1.3, 0.9, 0.8. Let's talk about the orange. Orange is productivity, as I mentioned, output per man-hour worked. So it's the combination of the increase in the workforce and the increase in productivity rates that gives you GDP. Gross domestic product, of course, is the broadest measure of goods and services produced here in the United States, and it is only made up of two components: increase in the workforce and making workers more productive. So let's go to the middle of the slide now. You look at productivity rates, now you're talking. Up to 1.8% from 89 to 98. That one's easy to explain. Fax machines, computers, laptops. So we all became more productive pretty quick. Here's the problem. That peaked out over 20 years ago. Right? So you look at productivity 10 years after that, climbing not at 1.8% a year, down to 1.4%, and productivity this last 10 years down to just 1.2%. My grandfather, my dad's dad, the Norwegian side of the family, was one of 11 kids. Right? He came over to the United States, wasn't the oldest son. The oldest son in Norway gets the farm. So he came over, but one of 11. Now in the United States, the average woman has 1.7 kids. Right? It's not enough to keep up with population, nowhere near. If there's a bright side to any of this, I'm very curious that companies are starting to embrace technology because they can't hire workers. And productivity has been anemic for years. Janet Yellen, former head of the Fed, said it's just perhaps the lack of new ideas. But what I've seen, and it's somewhat anecdotal now, I'll give you one example. A client of mine helps run a construction company down in Chicago. They're rebuilding Great Lakes Naval Base now. Only boot camp for the Navy left in the United States. So they're starting with the dorms. They couldn't hire bricklayers. They had absolutely no interest in embracing robotics, but they wound up buying robots that could help transport the brick, even do some of the finish work on the brick. I'm telling you, these folks had absolutely no interest in technology, but they were interested in getting that brick laid, and they were interested in getting there somewhere at budget. Other examples abound. You're hearing more companies go black, meaning there's nobody on the factory floor. Lights are out. You have problems. The plant manager gets notified by their phone. But it's curious that companies are now embracing technology, not out of a love of it, but because they can't hire. And that, should that trend continue, will no doubt have a big impact on productivity growth. So I'm chomping at the bit, waiting for artificial intelligence, machine learning, augmented reality, among others, to finally kick into our economy and get productivity going. It's essential for growth because birth rates are so low. All right, before I go to the next slide, I want you to look at the far right side of this slide and look at the blue box. Folks, what we're talking about is the growth in the workforce over the last 10 years. Got it? 0.8%, 0.8%. Now I want you to look to the right of this slide. So go to the U.S. again on the right side. So I said the workforce in the United States grew 0.8% a year the last 10 years. The pros are forecasting that it's going to grow only 0.2% a year. 0.2. Not a big number. So this chart shows growth in the workforce, and it also shows growth in population 65 plus. So look at the far left. Japan's losing workforce. Kind of adds up over time, 0.7% a year, they estimate. Same thing with Italy. Same thing in Germany. They're losing population. Then look at the numbers of folks age 65 and older. The English translation here is you got fewer worker bees taking care of more and more retirees. So go to the U.S. again on the right side. Workforce increased just 0.2%, and then 3% a year is the increase in population above 65. 46 countries around the world, including Germany, Italy, Japan, China, and Russia, now have a shrinking population. Demographics are usually the main driver of economic growth, as I've just showed you, increase in workforce, increase in productivity rates. Now, because of all this, No major economy is growing as fast as it was before 2008. We need more workers. We got to make them more productive. So this just shows the labor force participation rate. Now, part of this is boomers retiring, part of it isn't. But it's a big number, and it's part of the problem that we face here in the United States. So able-bodied adults used to have 2/3 of them in the workforce. Now it's down to 63%. Doesn't seem like a big number, but you're talking millions and millions of people. So I'm going to spend a couple of minutes on the yield curve. Let's define our terms. X and a Y axis, interest rates over time. Typically interest rates go up the further out you lend your money. The normal sloping curve, right? So this spring, short rates went above long rates. Yield curve inverted in the spring when the 3-month Treasury went above the 10-year. Markets panicked for a week or two, but it wasn't really until August when the 2-year Treasury went above the 10-year. First time ever that the 30-year Treasury went below 2%. Pretty rare event. So historically, the U.S. economy has gone into recession 14 months after the yield curve inverts. The slowdown in growth is reflected in record low bond yields. Right? So the Fed controls short-term rates, as they did yesterday. Collectively, Wall Street controls intermediate and long-term rates based on our collective outlook for growth and inflation. So low, longer-term bond yields, pretty self-explanatory, telling you that collectively we all don't expect inflation to be much anything, and we don't expect growth to be much of anything either. Yield curves are considered one of the most reliable leading indicators of recession. They've preceded every recession in the last 60 years. But I got a chart coming up. You want to be clear that we don't go into recession every time the yield curve inverts. We've had a couple of occasions where the yield curve inverted. It wasn't followed by a recession. One of the first things that I was taught in managing money, 2 things. Never trust anybody that says, trust me. And the other is never trust anybody that says, this time it's different. But I'm standing in front of you this morning saying, it could be different this time around. Before the financial crisis, the yield curve inverted. Many blamed a glut of savings in countries like China with large current account surpluses. Turned out not to be different. We went into a recession. But this time around, the yield curve could be distorted because of $17 trillion of negative yielding bonds in Europe and Japan. So 1.75 may not seem like a big number for our 10-year Treasury, but it's a positive number. So as much of Europe and Japan struggles with negative rates, we have positive rates here in the United States. And some folks suggest that money's pouring into the U.S. to take advantage of that, keeping down the long yields. Now again, yield curve inversions are pretty accurate. On average, as I said, we go into recession within 14 months. So it's something you clearly want to pay attention to. But in my opinion, it could be skewed somewhat because of the 17 trillion of negative yielding debt. Got the question the other day, do you think yields will go negative here in the United States? And in my opinion, is no. And the reason is, as I mentioned earlier, the lower that rates go, the less effective it is in jump-starting the economy. Negative yields haven't worked in Europe or Japan. I mean, they're still struggling now. So there's a limit to how much we all want to borrow, even if the rate is cheap. You still got to pay the money back. You still have to find an intelligent way to deploy the cash. So lower yields aren't really the panacea or the cure-all that some folks suggest. So this just graphically shows you the yield curve. Orange is somewhat of a typical curve. We're going back to the end of 2013 on that line, the orange line. That just gives you the idea. Interest rates go up over time. The blue line happened towards the end of August, right, where you can see that the short end of the curve, left-hand side blue line, is higher than the right side. So just moving on quickly to this chart, the orange balloons, if you will, are when the yield curve inverted, but we didn't go into recession. Here's the bad side of the story. I think it's green balloons. So that's when the yield curve inverted and we went into recession following that. So you can see the vast majority of the occasions when the yield curve inverted, yeah, we went into recession not long after that, but it's not absolutely every time. You can see one in 1998, that's on the right side of the slide, yield curve inverted. That was during the Asian financial crisis. It was also when long-term capital management blew up, upset the financial markets. And then on the far left, you can see the yield curve inverted in the mid-60s, did not precede a recession. So the answer is, yeah, most of the time, but not every time. I have a client here in the room. I'm not going to embarrass him, just his first name is David. What he has to do with the story I'm about to tell. I started taking piano lessons a year and a half ago. It's hard. You have to understand the right keys, the rhythm, ties, slurs, lifts, dynamics. So it dawned on me that, okay, I'm going to be at this the rest of my life. So I think really long term, I'm lucky enough to live long enough, my late 80s, 90s, I'm still going to be taking piano lessons. It's that hard. So my client and my friend David started taking piano lessons after he retired. This is how hard it's going to be. So after 4 years, he volunteered to play at a nursing home. Played his heart out the way I heard the story. And an older lady came up to him afterwards and said, keep practicing. Me personally, I'd be indignant. I'd be so furious. And he took it as a champ and went to practice more. And I think piano lessons is really for the long haul. Maybe not a great analogy, but so is stock investing. You know, seriously, I don't worry about stocks not going up longer term. Sure, I worry plenty short term. I have no idea what the market's going to do today or tomorrow. But I do know that longer term stocks do well. There's a reason for that. You look at the last 200 years of market history, stocks have gone up 7% plus the inflation rate. Way back in the 1800s, when most of us lived on farms, during the Industrial Revolution, even in the 20th century, stocks averaged 7%. So I'm pretty confident standing up here this morning saying, you know, give or take, I think stocks are going to average 7% plus the inflation rate moving forward. But you got to be a long-term thinker. Clients that I work with that are blessed with long-term thinking do really well as investors. So think about all 10-year periods of time. So we're starting this thing off since the Great Depression. Every single rolling 10-year period of time, stocks have made money 98% of the time. It's a lot. 91% of all 5-year periods, stocks have made money. And then, of course, 100% chance of profit for all 15-year periods of time. So please, 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 think long-term when you own stocks. You have the stocks for growth. You address market volatility, of course, with bonds. We're going to put your money in investments where we're drop dead positive about the stability of the money, plus or minus 1% or 2%. Think back 40 years ago, last month, the Dow was at 867. Think of that, 40 years ago. All right, specifically on stocks, Markets are starting to shift. For years and years, the markets have favored growth stocks, FANG stocks, if you will. Starting to shift just a tad. A couple reasons why. One is sectors like utilities, real estate, consumer staples have hardly anything to do with the Chinese. We Energies doesn't care what's happening in China. So you're seeing companies that are mostly dependent upon the United States for their revenues and earnings are doing better now. Look at some of the tech stocks running into buzzsaws of antitrust, privacy issues, and now the slowdown in China. It's never one side of the boat or the other. I say that all the time. We've all made way more money on growth stocks than we have on value, but recognize that value stocks hold up really well relative to growth stocks in a market decline. Think back in the financial crisis, a lot of growth stocks lost over half their value. Now you're still going to be good and crabby with your value funds going down 26, 28% as they did in the financial crisis, but it's nowhere near like losing half of your money. So historically, higher quality companies with strong balance sheets, high return on equity, good cash flow have held up better at this point in the cycle. So after the president signed the tax bill in December 17, we saw a lot of companies buying back their shares, reduces the amount of shares outstanding, increases earnings per share, of course, was pretty positive for the market. Unfortunately, share buybacks are fading quickly. They're at the slowest pace in a year and a half. Explains part of the volatility in the markets. I've kind of beat this second point to death. Companies are sitting on cash. Sector tilts are important. I think it's important to look at your growth versus value split. Make sure you have enough in value. What's happening to some of our funds is they've become growthier, if you will. They're in the core and they've been nipping at the growth edge, so it's been skewing more clients over into growth camps. Dividend strategies tend to outperform in the early stages of easing. I've always liked dividends. You know, when I first started doing this for a living in the 1975, early 76, it was common for most stocks to pay dividends higher than bonds because it was viewed that stocks had way more risk. So I'm going to spend a little time talking about the technicals in the market, but please understand earnings projections are forward estimates without potentially the benefit of an economic forecast. So what they call on the street their bottoms-up analysis, they're just looking at a particular company without the macro implications put on top. I'm going to make some forecast here for earnings, but should we go into a recession, these numbers are going to come down pretty quick. So earnings are flat year over year, decline the last 2 quarters. It's referred to as an earnings recession. S&P's trading at fair values, in my opinion, give or take at 16.2 times 12-month forward earnings, just above the 20-year average. Earnings are forecast to grow 11% next year, almost 9% the year after next. And again, keep in mind, should we go into a downturn, those numbers won't be anywhere near accurate. This year, the pros thought in the beginning of the year their earnings would be up almost 5% for the year. We're going to be lucky to clear a 1% increase in profits this year. So I know many of you know this, but the reason why we dwell on earnings is because stock prices parallel earnings increases year over year, okay? And it's not a nice tidy each year. I mean, the market's having a pretty good run this year. I just got through telling you that earnings are going to be up just 1.2%, give or take, for the year. So there's not a strong correlation between earnings increases in a particular year and stock prices, but long term it catches up with one another. And if you look at 20, 30-year look backs, it's almost dead on the money. So this year, as I said, this chart's even outdated. It was only done a couple of weeks ago. 1.8% increase in earnings for this year, 11% next year, and 9% for the year after. So I'm going to spend a couple of minutes talking about the difference between earnings and interest rates. I'm going to talk about forward PEs just to get a sense of relative value in the markets. So the dotted line, horizontal line across the chart, just average forward PE for the markets since 2004, 15 years, right? The average is 15.7. So we're just a little over 16. So you can see that the market is, I can't tell you it's a screaming buy right now, but I don't need to tell you that it's expensive either. So whether you look at price to earnings, price to book, price to cash flow, the dividend yield, markets are in pretty good range. All right, so here's the lesson on earnings and interest rates. Let's start with the right side of this chart, please. So they expect the S&P 500 to earn about $164 all told this year. You divide it into the S&P of just under 3,000, gives you an earnings yield of 5.7%. Got it? So you can take $1 out of your pocket, get 5.7 cents of earnings off of the average stock. Or you can take $1 out of your other pocket and buy a bond. The 10-year shot up a little bit since this chart got printed, but the 10-year Treasury right now is give or take 1.7%. Let me tell you how rare that is. The dividend yield on the market right now is 2%, give or take. It's pretty rare that the dividend yield on the market is above the 10-year Treasury yield. Rare. Hardly ever happens. It's a good thing for the market. Long term, it creates fundamental support based on where bond yields are at. So the blue line is the earnings yield on the market. As I said, 5.7%. The orange line is the yield on the 10-year Treasury. What you see now is that spreads are widening. It's good for stocks. So look at the far right-hand side. Blue line, yeah, it's coming down because the market's going up, so yields go down. But so is the orange line. If you look at the gap between the two, it's significant. Look at the left of center on that chart where you can see the lines cross over. Okay, there's trouble. Just right after Y2K, the markets got hammered. Okay. So you want to pay attention to this. You want to look at how much can you get, just real practical. How much can you get for your dollar with earnings versus what can you get on a yield on a bond? You need that spread to be healthy or people wouldn't take the risk and go into stocks. Years ago, I used to give lectures on the tortoise versus the hare. Fair amount of wisdom in that fable. A lot of new people come into my office, want to bet on some fast rabbit. But that old turtle won the race, right? Make slow, steady, methodical progress, week in, week out, year in and year out. So I'm referring, of course, to value stocks. My entire career, I've liked value. And one of the reasons is you get a deal on what you buy. I mean, the whole definition of value is so simple, it's just below average PEs compared to the market. So the basic definition is it's below average. So all the money that I've made for myself and for you all, you try to focus on getting a deal on what you buy. All right, I get it. It might become a better deal, might stay a deal. But it's hard to look dumb longer term if you got a deal on what you bought. Right? So I always marveled over long-term look backs that value stocks have done better than growth stocks up until this decade. So it all switched. I don't think it's going to come way back and we're going to embrace value. But at a time when value's been all but ignored, I remember 1999 being interviewed by the Milwaukee Journal trying to defend Ab Nicholas, who I always thought was brilliant. And it wasn't any problem on his part, it's just that value fell out of favor. And it's out of favor now, and I think it's going to start to come back, and it's the perfect positioning in the event that we get rough waters ahead. So the market is clearly chasing growth. I'm pretty positive you can't see the data points on this slide. Let me make it easy for you. On the left side, we're just measuring out S&P 500 growth stocks. Got a forward PE of 21. Okay, so 21's high. 21's a bigger number than 16, the forward for the overall market. Look at the value side. Forward PE on value stocks is 13.9. All right, so I like getting a deal on what I buy. All right, I can live with the fact that it might stay a deal, might even become a better deal, as I said, but there's value there. So if you look at this next chart, it shows, what we're up against. In every category of asset size, growth stocks have done better. Large cap, mid cap, and small caps. Every single category. So we talk about dispersion, which is the difference in performance figures between various asset classes. Dispersion keeps doing this. It's getting wider. Year to date, blue line's bigger. That's growth. 1 year, 3 year, 5 year, and 10 year. The blue line's bigger, right? Look at the 20-year numbers. Boy, neck and neck. And then 30-year, I'm going to call that a tie. Risk and return. There's more risk in growth stocks, higher betas and what have you. But if you look at the 20-year and the 30-year numbers, they're basically tied. I'd rather have a smoother ride. I'd rather have a stock that pays bigger dividends. Really hard to forecast where this is going, but I'm kind of trying to put a plug here for value. As I said, it's not one end of the market or the other, but you folks are going to need both. Just a quick comment on the emerging markets. It's really been dismal. For years it's been dismal. If you look at the orange line, the one on top, that's the developed markets since the beginning of 2013. So on average, developed markets are up, call it 80% since the beginning of 13. Look at the blue lines down at the bottom. All told, emerging markets are up a puny 7% since the beginning of 13. So we got a lot of problems with Asia. Asia is not contacting many of the emerging countries who primarily dig raw materials out of the ground, stick it on barges, send it to China. As China slows, they don't call as much. We've got a problem with dollar-denominated debt in the emerging markets. After the financial crisis, bankers got a little smarter, started lending money in dollar terms to emerging markets. That all works good till it doesn't. Let's say you're in Malaysia, you borrowed $1 million to get your business going. The Malaysian currency fell 20% against the US dollar. You effectively owe $1 million too. Right, that's strike one. Strike two is it's going to be even harder for you to pay the money back as your economy slows. Long-term emerging markets are one of my favorite asset classes, all day long. But again, it's like me trying to get good at the piano 20 years from now. You got to be a long ball hitter. But as I tried to teach you about the two components for GDP, workers, got to make them more productive. The average age in Asia is 20. The average age in the United States is 42 now. Right? So they got the wind to their back. Demographics are going like this in Asia. Long term, it's my favorite asset class, but it sure has been struggling. So I'm setting you up. For those of you that can think longer term, might be a good idea to slowly start acquiring positions in the emerging stocks. We haven't done a lot of work in that area for good reason. it hasn't made much money. I'm going to switch over to bonds here just for a minute. As y'all know, bond yields are plunging as we brace for a possible recession. Bond market's clearly pricing in lower growth and low inflation in the years ahead. Fed, as I mentioned, is lowered twice now. Bond market's already priced in 3 rate cuts. Probably get another one maybe in October, but surely, if not in October, then a couple in the springtime. Consider that the German 10-year equivalent treasury, they call it the Bund, has a negative 0.7 yield. Negative 0.7 yield. You're paying for them to hold on to your money. It would be cheaper to just buy a big old safe and stick it in your basement. So on bonds, you want to stick to quality. It gets harder to pay back money when the economy weakens. Avoid the temptations of higher yields. That was a great idea a couple of years ago. Spreads are too narrow now. I want to put in a plug for municipal bonds. Remember about 10 minutes ago I mentioned that I think it could be a little bit different with the yield curve this time because of money from overseas coming into our 10-year treasury to avoid negative yields in their home countries. But foreigners don't buy municipal bonds because they don't care for the most part about our tax laws. So munis got skipped last month when interest rates plunged. I got taught to tell all of you to buy municipals when they're at least paying 80% of the underlying treasury rate. Guess what? There are all sorts of munis out there that are paying more than the treasury rate, not just 80%. So that's a bargain. It won't stay a bargain, but I hate paying income tax. And I look at this opportunity that's fairly unique, and it won't last forever. And then a final point on bonds. Inflation's low. Inflation has been the arch enemy of bonds. So here's the high yield spread story. Years ago, Michael Milliken, Marty Frinson, Merrill Capital Markets, and others figured out that if junk bonds pay 5% more than underlying treasuries, and with an average default of 2.8%, net, you're going to make more on high yield than you will on treasuries. But that only makes sense if the spread is high enough. So if you look at the far right side of this slide, you can see that the spreads are well below 5%. So you're not being paid enough for the risk you're taking, which is, again, the risk-reward relationship is so important when you talk about investing money. In 1990, Harry Markowitz, University of Chicago, gets the Nobel Prize in Economics for his theory of asset allocation. It was widely thought prior to 1990 that Wall Street added value in relationships because of stock selection and market timing. Markowitz blew that up. They figured out that market timing and stock selection is only 8% of how well you do. My friend Don Phillips, Joe Mancuso, Joe Ruckenthaler started a company called Morningstar because of what I just told you. A couple years after that, Morningstar was willing to underwrite a public television show that I did for a number of years to be able to teach asset allocation. And one of the most important things I learned was the concept of efficient frontiers. At what point when you're increasing the risk in your account is the next unit of risk not worth the reward you get? Got it? Risk is a good thing until it turns into a bad thing. I like risk. I like to get paid on risk. But I want to make sure I get paid enough for the risk I'm taking. So the efficient frontier studies clearly convinced me years ago that there's a point at which additional risk isn't worth it. And most of you know this punchline. You get much past 60% in stock, your risk keeps going up, your return line flattens out. So this chart, we try to update every year, one of my favorite, There's something different you're looking at this year. Okay? The crash of '87 is no longer on the slide because it's 30-year lookbacks. I managed plenty of money back then, October '87. Market lost 24% of its value in 20 minutes. It was unbelievable. So that's off the slide. But here's the punchline. A 60-40 split, 60% stocks, 40% bonds would have returned 9.3% versus if you went all in, you'd average 10.5% a year. So we're talking only 1.2% difference on your money for 60% more risk. Okay, 1.2, I get it, that'll add up over time. But for 60% more risk, that's not worth it. About as close as we ever get to being on time. I really appreciate everybody coming out this morning. We appreciate your business. Enjoy the rest of your day.